This AI playback is powered by Krone.
Many people focus on their salary to build wealth, but there's a clear distinction between earning a high income and actually becoming wealthy.
Right. Janine Mancini highlights this through the perspective of Robert Herjavec, who suggests that while high salaries are good, true wealth comes from capital gains. He points out that his most significant earnings came from selling a business, not just his annual income.
He mentions a specific piece of advice regarding property that seems to contradict common trading habits. Why is holding onto houses so central to this strategy?
The core idea comes from Charlie Munger, who told him to never sell a house. The logic is that real estate is a long-term game. If you can hold a property for at least 10 years, you are almost certain to see a profit. Time does the heavy lifting for the asset's value.
That sounds straightforward, but many investors still end up selling much sooner than that 10-year mark.
Correct. The main obstacle is liquidity. Often, people don't choose to sell early because they want to, but because they have to for financial reasons. This removes the long-term upside that Munger and Herjavec prioritize for building lasting wealth. It is a strategy that requires the patience and capital to wait out market fluctuations.
It highlights that the best financial advice often requires significant discipline to execute.
Playback is powered by Krone.
Diversifying your portfolio might actually be holding you back from making real money.
Well, Adam Hayes wrote about how the late Charlie Munger, who was Warren Buffett's right hand at Berkshire Hathaway, actually called wide diversification protection against ignorance. He argued that if you really know what you're doing, spreading your money across 50 different stocks just dilutes your best ideas.
Right, so he's saying if I have one or two really great picks, why bury them under 48 mediocre ones?
Exactly. He said that for people who can figure out what works, even 3 stocks will suffice. Concentration forces you to dig deeper into the company's economics instead of just following the crowd.
But most of us aren't exactly professional stock pitchers like Munger was. Isn't that risky?
Oh, he was very clear about that. He called most people know-nothing investors. For them, he actually recommended sticking with broad market index funds to avoid the high cost and complexity of trying to monitor too many individual positions.
So it's either go all in on a few things you truly understand, or just take the easy route with an index.
Pretty much. The goal is to avoid mindless filler that just raises your fees and blunts your winners. It's about knowing which camp you fall into and not letting dogma dictate your strategy.
It definitely makes you rethink the whole spread it out and pray approach.
Playback is powered by Krone.
Concentrating nearly half of a portfolio in a single stock is a bold move that many retail investors avoid.
Joey Fournette outlines how Li Lu, the head of Himalaya Capital, has done exactly that. He manages a highly concentrated portfolio, mirroring the philosophy of the late Charlie Munger. By focusing on high-quality businesses with wide economic moats, he avoids the trap of diversifying just for the sake of it.
That specific holding is Alphabet, and the numbers are quite striking.
Right. Alphabet makes up over 43% of his firm's portfolio. It has surged 133% over the past year. Despite that growth, it still trades at roughly 29 times trailing earnings, which Lu sees as a reasonable valuation for a leader in artificial intelligence.
It sounds like he is not just chasing tech, though, as other sectors are represented in his top picks.
Exactly. Occidental Petroleum is another significant driver, rising 40% year-to-date. Li Lu is a patient, long-term investor who rarely makes major changes to his holdings each quarter. This disciplined approach demonstrates how staying the course with undervalued, dominant companies can lead to exceptional returns.
It is a clear example of how high-conviction investing can outperform traditional broad market strategies.
AI playback is powered by Krone.
Ever wonder why people say the first $100,000 is the hardest part of building wealth?
Oh, totally. Isabel O'Brien wrote about this looking at Charlie Munger's perspective. He basically said, once you hit that 6-figure mark, compound growth really takes the wheel.
Right, but getting there takes forever, doesn't it? If you're tucking away $650 a month, how long are we talking?
About 9.5 years at a 7% return. In that first year, you're putting in $7,200, but only seeing $546 in returns. It's a It's a slow crawl.
So for a decade, it feels like nothing is happening, but then it just speeds up.
Exactly. Between year 9 and 10, your interest starts to outpace your contributions. You might invest $7,800 but see over $14,000 in growth. It's like the money finally starts working harder than you do.
Okay, so once you survive that first decade to $100,000, how much longer until you're looking at $1 million?
If you keep that pace, it's about another 24 years. It sounds long, but the wealth basically doubles every 7 to 10 years at that stage. You're hitting $500,000 around year 25, and then it just skyrockets.
Munger mentioned being rational and underspending. Is there a trick to doing it faster?
Ryan Greiser suggests focusing on income over portfolio optimization. Adding an extra $1,000 to your monthly savings gets you there way faster than chasing a 1% higher return. Plus, automating everything so you don't spend your tax refunds helps avoid that lifestyle creep.
Basically, just push through the initial torture to reach the magic numbers.
AI playback is powered by Crone.
What if the best way to hit your goals is actually to focus on how you might fail at them?
Right. Amanda Caswell has been looking into this mental model from Charlie Munger called the inversion rule. Instead of asking how to win, you flip it and ask how to lose, then you just avoid those mistakes.
So it is like planning for a disaster. How did she use AI to test that out?
Well, she has ChatGPT's memory mode on, so it already knows her habits. She basically told it to be a brutal auditor and asked how someone with her skills stays underpaid and stressed.
Did it actually give her real answers or just generic advice?
Oh, it was specific. It called out her strategic drift, where she works hard but never stays on one thing long enough to see progress. It also pointed out how she spends 80% of her energy just reacting to short-term deadlines.
That sounds like a bit of a wake-up call. Did she apply it to the stress side of her life too?
She did. She asked the AI how to guarantee total burnout by the end of the month. It told her to check Slack the second she wakes up and to say yes to every quick call that comes her way.
Okay, that is a bit too relatable. It is wild how seeing those habits as a deliberate plan for misery makes them harder to ignore.
Exactly. She ended up realizing she needed to do less, not more. By focusing on the minus side of the equation, she could actually cut out the sabotage.
This AI playback is powered by Crone.
Did you know that one of the world's most successful investors once lived in what were described as dreadful bachelor digs and drove an old yellow Pontiac with a terrible paint job?
Right. According to Janet Lowe, Charlie Munger went through a massive reset in the early 50s after a divorce that left him with very little money. He wasn't always the billionaire vice chair of Berkshire Hathaway.
Okay. But he was a Harvard law grad, right? I imagine he was making decent money as an attorney in California.
He was, but he realized law had a ceiling because his income was tied to his time. On top of the financial strain, his young son, Teddy, actually passed away from leukemia during that period.
That's heavy. How did he keep going after something like that? I'd imagine most people would just shut down.
He followed what he called an iron prescription. Basically, he refused to play the victim and believed that if you think someone is ruining your life, you're actually the one doing it by not fixing it.
So that drive to get rich, was it just about finally being able to afford a luxury lifestyle, like a collection of Ferraris or something?
Actually, no. He explicitly said he didn't want Ferraris. He wanted the independence because he thought it was undignified to have to send invoices to other people.
So it was all about freedom from the start. That is a powerful way to look at success.
AI playback is powered by Crone.
Does it ever feel like we're just conditioned to be constantly doing something with our money? Like if we're not trading, we're losing out?
Right. Piers Shukla actually wrote about this. Looking at the wisdom of Charlie Munger, he highlights how Munger believed it takes real character to just sit there with a pile of cash and do absolutely nothing.
Doing nothing sounds so easy on paper, though. But I guess when everyone else is bragging about their quick wins, it gets tempting to jump in.
Exactly. It's that fear of missing out. Munger's whole thing was avoiding mediocre opportunities and waiting for what he called the fat pitches.
So he'd literally just wait for years if he had to? That's a lot of discipline for someone managing billions at Berkshire Hathaway.
It really is. He even pushed Warren Buffett to stop just looking for cheap, average companies and start buying high-quality ones like Coca-Cola at a fair price.
It's interesting that he started as a lawyer at Harvard Law School before moving into investing. Maybe that's where he got that analytical wait-and-see mindset.
Maybe. He was obsessed with psychology and how people make bad decisions, which led to his famous mental models for staying rational when markets get volatile.
It sounds like the real secret to that $900 billion market value wasn't being the fastest, but just being the most patient. Thanks for...
AI playback is powered by Crone.
We are looking at the unique perspective the late Charlie Munger held regarding Elon Musk.
Right. In a report by Janine Mancini, Munger described Musk as both extremely talented and quite peculiar. He adopted a neutral investment stance, stating he would neither buy into Musk nor sell him short.
That is a very specific middle ground. It seems Munger respected the ability, but maintained his own strict investment discipline.
Exactly. While others were swept up in the Tesla hype, Munger preferred companies like BYD. He valued execution and market positioning over the personality of a leader. He even once told Musk directly all the ways Tesla might fail.
Musk actually agreed with those risks at the time. Did Munger ever acknowledge Tesla's eventual success?
He did. Munger eventually called Tesla's success in the automotive industry a minor miracle. It showed that he could recognize a remarkable achievement without necessarily changing his core financial strategy regarding the stock. This nuanced view allowed him to appreciate Musk's talent while remaining a disciplined observer.
A rare example of separating the person from the portfolio.
Is powered by Crone.
Could you actually stomach seeing your entire stock portfolio drop by 50% in a single year?
It sounds brutal, but according to Tabai Opeyemi Amur, the late Charlie Munger believed that's the price of admission. If you can't react with equanimity to those massive drops, he said, you're basically settling for mediocre results.
Equanimity is a big word for when you're losing half your money. Has this actually happened to the big players, or is it just a theory?
Oh, it's very real. Look at the 2008 financial crisis. Berkshire Hathaway itself lost more than half its value. Amazon and Apple have also seen 50% drawdowns.
Right, so even the giants bleed. But how do you stop yourself from hitting the panic button when everything is in the red?
It's about the fundamentals. Taylor Kovar mentions that if the company still has strong leadership and a healthy balance sheet, you hold on. You also need enough cash on hand so you aren't forced to sell at a low point.
Okay, but wouldn't it be easier to just stick to safe stuff like CDs or high-yield savings?
Sure, but Munger warned that being too cautious means your returns might not even keep up with inflation. True wealth building requires enduring that temporary pain to catch the big recoveries.
So it's really a test of emotional grit as much as financial planning. That's a perspective shift.
This AI playback is powered by Crone.
Have you ever felt like you're drowning in facts, but not actually getting any smarter?
Right. Shreya Biswas wrote about how the late Charlie Munger, the vice chairman of Berkshire Hathaway, completely rejected that kind of surface-level memorization.
He was Warren Buffett's partner for decades, right? I'm curious what his secret was for actually processing all that information.
He used this phrase, a lattice work of theory. Basically, if you just remember isolated facts and try to bang them back, you don't really know anything.
A lattice work. So like a mental structure where everything connects?
Exactly. He believed facts are only usable if they hang together. Otherwise, you're just hoarding information without a purpose.
It's interesting how that played out at Berkshire Hathaway. Didn't he convince Buffett to change their whole strategy?
He did. He pushed the company to stop buying struggling, cheap businesses and instead focus on buying wonderful businesses at fair prices.
That's a huge shift in mindset. It sounds like he really prioritized deep thinking over just being busy.
Definitely. He actually warned that people who multitask pay a huge price because they never have time to think about anything deeply. He basically said they give the rest of the world an advantage by drifting into that mistake.
That is a convicting thought for today's world.
This AI playback is powered by Crone.
Ever wonder how Charlie Munger kept such a level head while everyone else in the market was panicking?
Actually, Steve Burns writes about how Munger basically used ancient Stoicism to build his mental discipline. It's less about math and more about seeing the world without all that emotional noise.
Right, I've heard him talk about inverting problems. Instead of asking how to succeed, he'd ask what would guarantee a total disaster.
Exactly. He called it invert, always invert. It's like the Stoic practice of rehearsing misfortunes before they happen so you can engineer the absence of failure.
He was also pretty brutal about his own ideas, wasn't he? I remember him saying, a year is wasted if you don't destroy one of your best-loved beliefs.
Oh, for sure. He treated his beliefs as hypotheses, not possessions. He even had this rule that he wasn't allowed to have an opinion unless he could argue against himself better than his opponents could.
That's a high bar. What about that weird word he used, Lollapalooza? What was he getting at with that?
Right, the Lollapalooza effect. That's when multiple forces, like psychological biases and economic trends, all hit at once. It's like a critical mass in physics that causes a massive explosion or a market bubble.
Okay, so it's about spotting those connections. It seems like he relied a lot on simple checklists, too, just to keep his own brain from tripping him up.
He really did. He compared not understanding probability and psychology to being a one-legged man in an ass-kicking contest. Using a checklist helps lock in what you can control so mood or fatigue don't ruin the decision.
It's a solid reminder that while tools change, the wisdom of staying rational never really goes out of style.
This AI playback is powered by Crone.
Why do we always hear about the one startup that hits it big and never the thousands that just disappear?
Right. Well, Janine Mancini actually looked into this through the lens of the late Charlie Munger. He was incredibly blunt about it, saying that for every guy who actually succeeds, there are 1,000 failures behind them.
1,000 to 1? That is a brutal reality check for anyone with a pick deck and a dream.
It really is. He described the secret to life as just advancing 1 inch at a time, rather than looking for that nutty overnight explosion that rarely happens.
Okay, so slow and steady. But what about all those founders who promised the world to get investors on board?
Munger had a very specific warning about that. He said, over-promising is a guaranteed way to make people hate you because you're failing their reasonable expectations.
I guess that explains why some valuations just crater when the growth numbers don't match the original hype.
Exactly. When there's a gap between the promise and reality, it doesn't just hurt your reputation, it hits the actual value of the company. It's much better to just be honest about the climb.
Definitely a good reminder that the boring incremental progress is usually the more reliable path.
This AI playback is powered by Crone.
Have you ever wondered why some of the smartest people in the world act completely different from what you'd expect? I mean, they don't always seem like the fastest thinkers in the room.
It is interesting, right? Steve Burns recently wrote about how Charlie Munger looked for specific, almost odd behaviors to spot high IQ. It wasn't about raw processing power, but more about rationality and sidestepping mental traps.
Munger was famous for that phrase, invert, always invert. It sounds a bit like being a pessimist, doesn't it?
Actually, it's a risk strategy. Instead of asking how to succeed, he'd ask what would guarantee failure and then build a mental fence around those disasters. He once said, "Tell me where I'm going to die, so I'll never go there."
Okay, that's a very practical way to look at it. But I also heard he was known for just sitting there at meetings and saying, I have nothing to add.
Exactly. He called it knowing your circle of competence. While most people feel pressured to have an opinion on everything to look smart, he believed refusing to weigh in on things you haven't studied is a sign of a superior mind.
So it's okay to stay quiet. What about his approach to work? I've read he would go months without making a single big move.
He viewed frantic movement as a sign of weak thinking. To him, the money is made in the waiting, not the buying or selling. He'd sit and read for ages just waiting for what he called the fat pitch.
That takes incredible discipline. He also pushed for learning things that have zero to do with your actual career, which seems a bit unfocused.
He called that building a latticework of mental models. He didn't like narrow specialists because if all you have is a hammer, everything looks like a nail. He wanted you to pull from physics or biology to solve business problems.
The final thing that stood out was how he'd argue against himself. He wouldn't even allow himself to have an opinion until he could argue the other side better than his opponents could.
It's the ultimate quality control for your own reasoning. By hunting for evidence that he was wrong before someone else found it, he could keep his ego from clouding his judgment.
It really changes the perspective on what being smart looks like. It's less about having the answers and more about the discipline to think differently.
This AI playback is powered by Crone.
Could a simple list be the secret behind a multi-billion-dollar empire?
Well, Jocelyn Fernandez actually breaks down how the late Charlie Munger swore by a checklist to solve hard problems. He helped grow Berkshire Hathaway into this massive empire by basically following four simple rules.
Right, so it wasn't just guessing. What exactly was on that list?
First, you only touch things you actually understand. Then, you look for a business with a durable competitive advantage and management with real integrity. Finally, even if it's a great company, you don't pay an infinite price for it.
Okay, but if it's that simple, why isn't everyone a billionaire like Munger was?
He actually joked that the ideas are almost too simple to spread. He said the professional classes can't justify their existence if it's all that obvious. They need to fill a whole semester with something more complex.
I guess that makes sense. It reminds me of Warren Buffett and his preference for those really short contracts.
Exactly. Buffett mentioned he still goes for one-page deals. He says if he needs 50 pages of legal text to protect himself from someone, he'll just spend the whole time wondering if he actually needed 51.
That's a pretty sharp way to look at trust. Seems like their combined approach really paid off in the long run.
It really did. Under their management, Berkshire saw a 20% annual gain from 1965 to 2022. That's about twice the pace of the S&P 500. It's a great reminder that simple discipline usually beats overcomplicating things.
Hard to argue with those numbers. Definitely gives me something to think about for my own projects.
This AI playback is powered by Crone.
If you had over $2 billion, would you really trust almost all of it to just three investments?
Well, according to William Dahl, that's exactly what Charlie Munger did. He actually called diversification a rule for know-nothing investors.
That's a pretty bold stance for someone managing billions at Berkshire Hathaway. So what were these three high-conviction picks he lived by?
The biggest chunk, like 90% of his net worth, was in Berkshire Hathaway itself. Specifically, he held 4,033 Class A shares worth about $2.2 billion.
Right. I mean, that makes sense given his history there. But what about outside of Berkshire? I heard he was a huge fan of Costco.
Oh, he was a total addict. He owned over 187,000 shares of Costco and even served on their board for decades. Since he passed in late 2023, that stock alone has returned 47%.
47% is incredible. And the third one, was it another big household name?
Actually, he put $88 million into Himalaya Capital, run by Li Lu. It's a private fund, but their biggest holding is Alphabet, which has surged 130% recently.
It sounds like his strategy really paid off, even if it goes against the typical advice of spreading your risk thin.
It really did. While Berkshire and Costco slightly trailed the S&P 500's 52% jump, those businesses have such massive moats that they're considered much more stable over the long haul.
Clearly, Munger's philosophy of buying wonderful businesses at fair prices is still proving its worth.
Playback is powered by Crone.
Could you imagine being 99 years old and still out there buying up apartment buildings just to keep yourself busy?
Right. Janine Mancini actually looked into this, and it turns out Charlie Munger was doing exactly that right up until he passed. He wasn't even looking for quick cash or high payouts like most investors.
Okay, so if he wasn't looking for high income or distributions to live off of, what was the goal? Just a hobby?
He called it intelligently spending money to make the buildings better. It was all about deferred gratification, which he compared to that famous Stanford marshmallow test with the kids.
Oh, I remember that one. One marshmallow now or wait for two later. So he was basically playing the long game with real estate?
Exactly. He believed that the kids who could wait for the second marshmallow were the ones who succeeded in life. He applied that same patience to these apartment houses, focusing on improving the asset over time rather than enjoying the money immediately.
It sounds like a simple principle, but I bet it is much harder to actually do when you're staring at a potential payout.
Definitely. But for him, it was about behavior over scale. Even if you aren't a billionaire at Berkshire Hathaway, letting time do the heavy lifting is a strategy that travels well.
A pretty incredible way to look at life and money, especially at nearly a century old.
This AI playback is powered by Crone.
Have you ever wondered if there's a single secret habit that the most successful people in the world actually share?
Well, Arshdeep Kaur wrote about the late Charlie Munger, who was adamant that it's constant reading. He said he never met a single wise person across any field who didn't read all the time.
Zero? That is a bold claim. He and Warren Buffett are famous for just sitting in their offices reading most of the day, right?
Exactly. Munger even joked that his children saw him as a book with a couple of legs sticking out. He called himself a learning machine.
I love that image. But is he just reading business reports, or is it broader than that?
It's much broader. He pushed for a lattice work of mental models, meaning you need to understand physics, biology, and psychology too.
Right, so you don't end up like the man with a hammer where every problem looks like a nail.
Exactly. He believed knowledge compounds like money if you diversify what you learn. To really apply it, he suggested setting aside 2 hours a day just for reading and reflection.
2 hours sounds like a lot, but for that kind of wisdom, it's probably the best investment we could make.